Hey, Arvind, welcome to Beyond MD. I know we connected some time ago, and I've been following some of your work. I think you've written some really good articles, especially on LinkedIn. And I recommend anyone who's wanting to learn a bit more about tax and CPP. Arvind's a great person to follow. But Arvind, welcome to the podcast.
Thank you. Thank you, Yatin. Thank you for having me.
Yeah, it's a pleasure. So, Arvind, maybe tell us a bit about yourself professionally. What do you do?
So I'm an associate at Ironwood Wealth Management Group. So at Ironwood Wealth Management Group, we are a wealth management firm. We focus on holistic financial planning. So that is everything from the investment planning all the way to sort of tax and estate planning for our clients. And I would say for myself, I have three main areas that I focus on, or three main clientele that I focus on. Focus on incorporated, business owners. So that's where often a lot of physicians or other healthcare workers will fall in. And then I also work with a lot of young professional families, usually in sales and marketing. And then third and finally, I have a core focus in midwives as well.
I love it. I want to start the conversation today by talking maybe a bit about the basics of CPP and tax integration. Like, I think you have written a little bit about how tax integration in Canada is near perfect, but not totally perfect. Maybe can you elaborate on this a little bit? And you've also talked about how this can maybe reduce the cost of CPP, but I'd love to hear a bit more about tax integration.
Perfect. Apologies. My computer just reminded me that it had to be plugged in. So tax integration is really fascinating. And so the idea of integration, that word, is the idea that for an incorporated business owner, if
Mhm.
they have a certain amount of money, and to move away from like the technical tax jargon, the way I like to explain it to a lot of my clients is, let's say your business makes $100,000 in what we call pre-tax profit. So you haven't decided if you're going to pay yourself as a salary or as a dividend. And so what happens is, if you choose to pay yourself as a salary, that money goes out, the corporation doesn't pay any tax on it, and then you have to pay a certain amount of tax on it. If, on the other hand, you choose a dividend, the corporation actually pays some tax first because now it's considered corporate profit, and
Mhm.
then the dividend is paid out to you. And so a lot of people look at just the tax that they pay personally on the dividend and they say, hey, look, dividends are more tax efficient or I pay less tax, forgetting that they paid a portion of tax inside the corporation. The idea of integration is when we add those two layers of tax on the dividend side, it comes out to almost the same as the tax that we pay on the salary side. Now that high level, yeah, and that's the sort of
Mhm.
the description of integration. Do you want me to get a little bit deeper on sort of the numbers around that?
Yeah, I'd love for some numbers, like if tax integration is not perfect, by what percentage point? And then I'd love a quick overview. We don't need to cover obviously all the provinces and territories, but generally speaking, is it most places favor salary a little bit? And then if there are a few outliers, what would those be?
Yeah, it's a great question. So I would say the percent, it's actually very close. So in Ontario, as an example, where I think most of your listeners are, the difference in integration or the difference in salary versus dividends on the tax side is about 0.5%. So what that means is if we use that $100,000 example, you're really only losing, per se, about $500 of extra tax when you pay yourself as a dividend versus as a salary. Now,
Hmm.
the percentages kind of range, and if you're earning small business limit income versus income above that small
Hmm.
business deduction threshold, the rates again change province to province. But in general, I would say the range is usually about, 0.3 to about 1% of a spread, and it usually favors salary. So that
Hmm.
means in most provinces and in most situations, you're better off from a tax standpoint paying yourself salary. The only two, or there's three specific nuances where that doesn't work out. Northwestern Territories, and I'm just pulling the other one. I want to say it is uh, Saskatchewan, currently at the small business limit, and then New Brunswick at that above that small business or that general rate, if you will. So I would say
Okay.
in most cases, and for most of your listeners, like all of your core provinces, yeah, Alberta, BC, Ontario, they all favor paying salary from a tax standpoint.
Now, I don't think most people listening to the podcast will have to worry about retained income that is above that $500,000 limit, but I'm just curious, are there any big picture rules of thumb? Like, let's say if you have retained income above $500,000 across the board, does it change very much in terms of salary versus dividend and the tax inefficiency, or is it relatively the same?
It's slightly higher, so the numbers get a little skewed. But basically, there's a few provinces where it's like 1 or even 2%. So again, that range is still the same, and it's very small. But again, now we're talking instead of $500, we're talking about like $1,000 of extra tax, 1,500 of extra tax. There's
Okay,
some,
so still favoring salary though.
yes, still favoring
Interesting.
salary.
Interesting. Okay, so now let's get to CPP
Yeah,
and some of the tax credits and deductions that we would be eligible for. So, quick story here, Arvind. So, this year, I decided to do something somewhat extreme. So, I actually printed off my tax return and I was like, I'm going to do it. And this time, I'm going to do the work before asking my accountant so many questions like I do every year. So I actually printed off the tax return, like
I
all
like where
90
this is going.
pages. You know what? And so I actually brought it to bed. And then my wife, Seema, kind of looked at me. She had this like look of shock and almost disgust. She's like, what is that? I was like, it's my 2023 tax return. She's like, you're actually going to go through that? And I was like, yeah, I'm going to go through it. I'm going to make some notes. I'm going to have a great conversation with my accountant. And then she quickly turned away from me, started watching her show. Like she wanted to have nothing to do with me at that point. So, anyways, what I saw was that there was a CPP tax credit on
Yeah.
my tax return. And that's something I hadn't seen before. So that kind of got me thinking. And then I started following some of your work. So I want to get into the personal CPP contribution and then or the employee contribution, then the employer. But on the employee side, how do the credits and deductions work when it comes to
Yeah, so
CPP?
great question. And I think it's important to also take a step back for some of your listeners
Yeah.
who might be like, wait, hold on. What do you mean salary is better? Right? Because I know there's some myths and misconceptions that dividends are always better. So I want to take a step back because one thing that often happens is we just spoke about taxes and we didn't talk about CPP. And
Yeah.
so one thing that happens often is many people will say, well, hey, how come I still come out better ahead with dividends? And it's because when you pay into salary, we only spoke about taxes, but salary has an extra layer of call it a cost, call it an expense, call it what you will, but there's an actual cash flow out, and that's CPP. When you pay salary, you have to pay into CPP. When you pay dividends, you do not have to pay into CPP. And that's why many people will still see their net cash, or their accountant will tell them, hey, in this scenario, you have extra cash on hand by doing dividends. And it's because you avoided paying the premiums for
Gotcha.
CPP.
Gotcha.
And so, in that context, what you just discovered is something that many people don't see, or it's actually very difficult to bring all those costs together. So, the default, what am I saving question that everyone asks is usually answered with, well, you're saving the amount that you would have paid into CPP,
Right.
which is in 2025 projected to be about $8,800 when we look at the enhanced CPP. So, that second layer that's kicked in now. So I think it's important to start with that because many of your listeners, if they are used to paying dividends, or if they go to their accountant now and say, hey, after this podcast, I want to switch, they're going to get asked, well, it's going to be an extra $8,800. And that's what we're about to talk about, which is
Yeah.
it's not truly that cost. So having set the stage for that, CPP is broken out into two pieces. There's the employer portion, and then there's the employee portion. So on the employee side, the first 4.5% is that base. So that's what existed first. If we go back through history, and I believe, have you had Jason Yee on your podcast?
I talked to Jason yesterday. Yeah.
Okay, awesome.
Yeah.
So Jason Yee probably gave a little bit of a history behind CPP, some of the changes, and so the original CPP, the employee portion, got a tax credit. So 15% federally, in Ontario 5% at the provincial level, so about 20% tax savings on that first 4.95% that has existed for the last number of years. So that piece comes out as a tax credit. If you're contributing the maximum amount to CPP, then we're looking at roughly about $600 to $670 of direct tax savings on your tax return. That's the original base. Now, everyone has probably encountered or heard of the fact that CPP contributions are going up, and that is as a result of enhancement.
Yep.
And so I won't go through all the details because I know Jason's podcast will cover that in very deep detail, but that extra contribution that is attributed to enhancement is actually eligible for a tax deduction personally as well. So, sorry.
No worries. No worries.
So the tax deduction,
Yeah.
the implication or the benefit on that is actually going to depend on how much income you're taking out of your corporation.
Right.
Because as we all know, a deduction is more useful at higher marginal tax brackets.
100%. Yeah.
And so on the employee side, I would say on the peak, it can be worth as much. And for many of your physician listeners, this will be relevant to them at those higher tax brackets. It can be worth as much as $574 in tax savings in 2025.
All right. All right. That's good to hear. So now what about the employer contribution? Like, is that something that is technically deductible to the corporation, the company?
Exactly. So just like salary
Yeah.
is deductible to the corporation, so if a corporation, if a medical corp, let's say they make 500,000, keep the numbers clean, and they're going to pay out 200,000. Well, the medical corp now only has 300,000 of profit left over. That full 200,000 is a deduction to the corporation. Just like that salary is a deduction, that employer CPP portion is a deduction to the corporation as
Okay.
well.
Got it. This is a bit of a naive question, maybe, but we've got the employer contribution, we've got the employee contribution. In the setting of an incorporated professional, whether it's a doctor, a dentist, who's making those contributions? Is it just the company, or does the company make half, and me as the individual, do I make the other half? How is it supposed to work?
Yeah. So, if and I'm laughing a little bit because when I actually went through doing the math and doing the
Yeah,
model, it wasn't as clean as, hey, if I do 100,000.
yeah,
So as an example, the exact predicted amount is $8,860.20. And so if I made 100,000, is the math like, hey, 100,000 minus, $4,430, that's what goes out to the employee, and then 4,000. It's not quite because of the fact that you actually have to account for what's being paid out as CPP as a part of the salary. But then when the employee receives it, it's like 5.5% or 5.95% of their personal salary
right.
that's being calculated. So there's like a weird calculation that you have to do to get right, like how much am I paying out? But in general, the way you look at it is if the corporation has paid the employee up to the maximum, so it's about 80,000 or just under $80,000 this year, the employee will have to pay $4,430.10, and then the corporation has to pay $4,430.10. And so philosophically, that's what happens. Corporation pays out, employee pays their portion, and then the corporation pays the corporation portion. I
Okay.
hope I didn't confuse anybody with that.
No, no, that's helpful. So now that we've talked about some of the tax credits, some of the tax deductions, and we've touched on tax integration and some of the inefficiencies that lie within there, if we put all of that together, I want to really try and nail down what is the true cost of CPP.
Yeah, and that's a great question. And I've actually got, so if we want to play around with some numbers in Ontario, I opened up my handy dandy, spreadsheet as well, just to, make sure that we've got the exact numbers. But as an example, in Ontario, the peak amount that, and the way I did this actually, let me go back for all of your listeners who like to hear about the methodology behind the research, if you will. What the best way to do this was everybody pays themselves a different amount, right?
Yeah.
Every physician is going to work a certain number of hours, or their specialty will have a certain amount of income, and so it's not one clean cut answer because deductions are more impactful at higher tax brackets. Integration is a tax on every single dollar that comes out. So as an example, we talked about 100K, that's a $500 difference, but 200,000 means a $1,000 difference. So what I did is I said, well, what happens if we took $1,000 of pre-tax profit and we paid it out as salary and then we paid it out as dividends? How much more do I have if I actually pay it out as dividends? Now let's do that for $2,000, in 3,000, 4,000, in $1,000 increments from 0 all the way to 300K of pre-tax corporate profit. And so what we realized was in the beginning, so from 0 to about 80K, as you're contributing more and your CPP contributions are going up, the cost does go up, and it peaks at $6,250, around the $88,000 threshold. So if you paid out 88K as dividends, you would receive about $6,250 more than if you chose to flow that out as salary. But on the other hand, from there, it actually starts to come down. So the amount that you have, or the amount that of extra money that you would receive by paying yourself as a dividend, starts to decrease from that $6,250. And so the extreme example, let's say 300K of profit that you now chose to flow out as a dividend, you do receive more, but you only receive about $3,387 more in hand.
Oh, wow. Okay.
And so it's a lot less than this
Way less.
$8,860
Way, that's way, way less.
option.
Yeah. Okay.
And the reason is, so there's a couple pieces that come into play. So we gave the employee side, the credit is like $600, which is great. The deduction is like 500.
Yep.
So that's awesome. So you can see how those already, knock off
Over 1,000.
$1,100.
Yeah, yeah.
But the employer contribution, which is $4,400, what everyone forgets is, in order to get that $4,400 out of the corporation, we have to pay both layers of tax
Yes.
fully.
Yeah.
And so for a physician pulling out 300K, that $4,400 is being taxed at effectively over 50%, meaning there's only an extra $2,200 that they're getting out of that versus having contributed. So that's one of the big costs that people overlook, is the tax impact of that full deduction having to flow through. And because integration is an impact on every single dollar,
Yeah.
0.5% doesn't sound like a lot until you realize that 0.5% of $300,000 is another $1,500. So when you look at that 1,500 plus the tax of the deduction plus some of the other pieces, those are what come together to make such a big tax differential.
That's really interesting. So there's basically four pieces there. You've got, for your CPP, you've got credits, you've got deductions, and then if you're going to contrast that to the dividend scenario, well, to pull that money out as dividends, you're going to be paying corporate tax, personal tax, and then on top of that, you've got tax integration inefficiency working on every dollar that's flowed out as dividends. So
Yeah.
there's basically like four layers there that are contributing. Yeah. Okay.
Exactly. And those four apply to every single incorporated business owner. And the reason we went at it this way is when me and my team sort of first went at this, and I was having this
Yeah.
discussion, both internally and talking with other accountants,
Yeah.
at first it was, no, you're crazy. And then you start to map out the credit and the deduction.
Yeah.
And then the first default, I think, for many people is, okay, fine, you're not crazy, but this really only applies to up to the YAMP. So at 80K, we're talking like 30%, deduction. It's not that big a deal. And so it's really been this iteration of chatting with people, getting feedback, getting rebuttals, and then saying, no, I don't think that's quite right, because we all know intuitively that deductions are more valuable at higher tax brackets. And so that's where it ended, at this methodology of saying, I think the only way to prove this is to do the increments. And I can send you the screenshot if you want to include it somehow in the podcast, or include a link or something like that, so that anyone can look at the graph, because I think the graph is really
Yeah,
good,
let's put a link
because
to it. We'll
shows
put a
that
link to it for
peak and
sure.
decline over time.
Yeah, absolutely. So I want to peel the wrapper off dividends a little bit more. I'll tell you one other quick story. I think listeners will appreciate this. This was another year when I was inspecting my personal tax return. I think it was 2022, or maybe even earlier than that. And I looked at my taxable income, and I was kind of scratching my head. And then I called my accountant and I said, well, listen, I only had dividends of this amount. Why is my taxable income this high? And then he just quickly replied and he said, oh, it's because of the dividend gross up. And then I was just like, excuse me? Like, what do you mean? What is that? How does it work? So that's what I want to ask you, Aravind. The dividend gross up, it was a new concept for me like 4 or 5 years ago. And I have to admit, I still don't fully understand it. So it's a great time to discuss it. What is that, and what impact does it have?
Yeah, so this applies both to people getting paid dividends out of their personal owned corporation,
Yeah.
but from an investment perspective in general, this is also really important, because eligible dividends from Canadian publicly traded companies, like banks and whatnot, also fall into this category. And so what happens, so again, to peel the layers back and give context, we just talked about how the corporation has to pay tax on the profits that they earn, and then they pay out the dividend, and then you pay your personal tax on it. And so what happens is, and I don't know like how the government sort of went through this, like how do we get this right? But essentially, in order to make sure that you aren't double taxed personally on that income, what they do is they gross it up. So they multiply it in the case of non-eligible dividends, which is what most physicians will pay under
Yeah.
that small business threshold. They gross it up by 15%. And that 15% is roughly meant to bring the income back up to what that pre-tax corporate profit amount would be. So by
Okay.
multiplying it by that extra 15%, it gets it pretty close, not quite, to the original earned amount in the corporation.
Okay.
And then there is another sort of multiplication or calculation, and that accounts for the dividend tax credit that you get. So if you inspected your return, you might have noticed that your stated income was higher, but then you would probably notice that there is a dividend tax credit sort of further down the line
Okay.
that offsets some of that tax.
I'll inspect
So
that on the next tax return for sure.
yeah,
I'll be looking out for that. Yeah.
so when your stated taxable income is higher,
Yeah.
you're like, wait, hold on. Does that mean I'm paying more tax? Well, yes, in a way. Like the tax return shows that Yatin would owe more, but then there is an actual credit that is provided to you that offsets that tax. And that credit is meant to reflect the taxes that your corporation already paid. And so that's why integration is really close and pretty good, but not quite perfect because of some of these rounding errors in like the gross up effect and then the dividend tax credit and how much the tax credit offsets the taxes that you would owe. And so the tax credit is meant to reflect the taxes your corporation paid. The gross up is meant to bring that income back up to what you originally earned. And when you sort of bring those layers together, that's how you get integration, which is close but not quite perfect. So that kind of explains the concept of the dividend gross up. I'll add one small addendum there, just in case
Yeah.
anyone is really curious.
Yeah.
Eligible dividends. So we talked about non-eligible, and they're grossed up by 15%. I don't remember the exact number, but I believe it's about 30 odd percent that the eligible dividend is grossed up by.
Oh, wow. Okay.
And so same thing though, you get a bigger tax credit for it. I'll actually look it up and see if I can find how much the eligible dividend is grossed up by. But you do get a bigger tax credit for it. The reason I point this out is some of the things we're going to talk about, like income tested benefits and things like
Yeah.
that. And a big one that impacts people who have a lot of eligible dividends is OAS clawback later
Okay.
on in life as they're decumulating.
Okay. Okay. While you're looking that up, I guess I'll kind of give out the preamble for my next question. So, okay, you get these tax credits when these dividends come out, but then your stated income, your taxable income goes up. That's going to have an impact on certain income dependent benefits. I know you've talked in your work about the Canada Childcare Benefit. I went to CRA's website, I looked through their algorithms, I did some calculations, and it didn't seem like we were going to be eligible for that, but I thought maybe you could shed a little bit of light on CCB, the Canada Childcare Benefit. And then part two is, if one's not eligible for that, are there other kind of income-based benefits that somebody may be eligible for that they don't know about already?
So first, for anyone who's curious, eligible dividends are grossed up by 38%.
Ooh, okay. All right, good to know. Yeah, yeah.
Now, keep in mind, again, you get a tax
You
credit,
get the
right? So
tax credit. Yeah, yeah, yeah.
it all
Yeah,
kind of offsets. It really it does just come down to some of these other like weird tax nuances that we're talking about.
yeah.
And so, Canada Child Benefit, it is kind of complicated and kind of simple at the same time. The simple element is if you have more kids, you get more money. The complicated element is they give you a different sort of base amount for children under 6, and then a different base amount if you have children over 6 up to the age of 17. And it changes for the amount of kids you have. So if you have more kids, that base amount is actually multiplied per child. So with 1 or 2 kids, roughly the household income has to be under 200,000 or around 200,000. And then for more kids, that sort of income threshold before you stop qualifying for Canada Child Benefit raises and raises to the point where at 300,000 for 4 kids under 6, you can still actually receive a small amount of Canada Child Benefit. Now I don't know many families that are having, 4 kids that tight together, but
Yeah.
I just felt I should throw that out. And so the point that I want to make about income tested benefits in general, so this applies to at lower income thresholds, it applies to things like the sales tax, Trillium credit, things like that. At higher incomes, unfortunately, there aren't really any that I know of
Okay.
per se. Save for everyone is obsessed with OAS clawback, and OAS clawback functions in a different but similar fashion.
Okay.
And basically, what happens is for every extra dollar you earn, there is a certain percentage that these benefits are reduced. And so in the case of Canada Child Benefit, the percentage changes based on the number of kids. But in general, for every extra dollar that you are pulling out of your corporation, your Canada Child Benefit, if you receive any, does actually get reduced by a certain percentage.
Okay, thank you for that. I want to play devil's advocate a little bit here, and I will say that I am in a salary heavy approach, so I contribute to CPP. But then somebody may come back and say, well, you know what? I don't want to contribute to CPP. I want to keep that money in the corporation because I believe I can invest in a way such that I will get higher returns. How do you address that?
That's a great question. And yeah, and I just realized, do you mind if we come back to CCB for 1 second? Because I
Yeah,
didn't drive the point home for all of your listeners
of
about
course,
why
of
the
course.
whole
Yeah, of course.
CCB dollar amount is important. So we just talked about dividends getting grossed up,
Yeah,
and it's close, but not quite. And then we talked about salary on the other hand. And so for everyone, just in case they don't remember, we talked about how the employer portion of CPP is a deduction and employee portion, there's a portion that's a deduction as well.
yeah,
And so what actually happens is your stated net income on the salary side, if you pay yourself, is less for that same amount of pre-tax profit than the stated income on the dividend side due
yeah.
to the gross up. So there's this spread. This spread, this increased stated net income is actually going to reduce the Canada Child Benefit by that certain percentage or certain
Yeah.
amount as well. And so that's where I would say, contact your advisor, or if you're someone who loves getting into the details of the tax return, like yourself, Yatin, then you got to do that work to see how it affects you. But that spread does apply, and if you have 2 or 3 kids, there's a good chance you may be getting some, and therefore, depending on your situation, you might be subject to this extra clawback, which
Okay.
then is a cost on your CPP.
Okay. So let's get to that scenario where somebody says, I don't want to contribute to CPP because I feel like I can do a better job investing the money within my corporation and get better returns that way. What do you say to that?
So that has been a common conversation or a common challenge to this whole approach. And so the first thing that I would say is, in general, I would say, have you done the numbers? Because what I typically see when I've thrown this out from other advisors or business owners is they're using sort of pre-tax nominal returns. Like, hey, yeah, equity markets have done 8% over the last number of years. Or even if you use FP Canada's assumptions, a full equity portfolio, gross of fee, they're assuming somewhere between 6 and 7%, depending on FP Canada, Vanguard, a handful of other papers. So someone will look at that, and then they'll look at some of these like CPP historical asset class returns, or they'll look at hey, if I paid $8,800 into CPP versus if I invested $8,800 personally, and I can grow 8,800 by 6% or 7% per year versus what CPP is going to give me. And that's how they get to those numbers. But as we just went through, those aren't really fair assumptions for 2 reasons. First is you're not actually paying $8,800 into CPP. You're paying a lot less
Right.
versus had you taken that money personally. So what is the starting amount that you're looking at? And the second is, if you're investing in your corporation or if you're investing in a non-registered account, there's tax that you have to pay all along the way. So that 6 or 7%, well, the dividends are going to get taxed. Realized capital gains, so if you're rebalancing your portfolio, those get taxed. And as your physicians all know, capital gains tax just got a lot more expensive, hypothetically,
Yeah.
inside of a corporation. So you have to account for the fact that taxes play a major role. Now, the other piece, and this one is I think it's important, but I think many people look at it as like a behavior or a choice piece, is you're taking on a lot of risk when you're investing in a full equity portfolio to get those returns versus the fact that CPP, by the nature of the government sort of backstopping it and a predetermined formula, is a guaranteed payout. So is a full equity portfolio the right thing to use, or should you be using like a GIC or a bond portfolio? Now, different people have different perspectives on this, but I think it's really important to note that when we get closer to the end of our life, a lot of us love the idea of some element of security or guaranteed income because that's what we're trying to do with our money.
Yeah.
Given all of these pieces, there's no clean way to, say, hey, this is how you compare apples to apples. So what I actually did was I said, well, let's look at a couple case studies. What if I took a single year of contribution for different age populations, different scenarios, like if they're a family with kids, if they're closer to retirement. And if I say we're going to contribute for a single year, right? So I'm going to map out a single year of CPP contribution, and then I'm going to take that single year of entitlement at retirement. How much will I receive? What happens with taxes? Because I'm going to have to pay some tax on it. And then what is my what's called an internal rate of return? And for anyone who doesn't know what IRR or internal rate of return is, it basically says, hey, if I paid a certain amount, so if I paid, $3,300 today, 30 years later, I'm going to start collecting some amount of money, let's say $4,000 a year or, $2,000 a year for the next 20 years. What is the rate of return that takes this 4,000 or 3,000 that I paid and turns it into this income stream in the future? And that would kind of be like, what is the hurdle rate that I
Okay.
need to make
Okay.
to compare it to CPP? And that was the way I went at it. Now I can talk about the numbers, but first, did I explain the
Yeah, yeah,
methodology?
perfect. That was great.
So for our young physicians, and this might actually be even a tad younger because I know many physicians don't incorporate until, like 30 or later because they might be using a lot of that income to pay for a mortgage. They're really only just wrapping up residency. But for a successful business owner at the age of 26 who incorporated, when I map those numbers out, if they're pulling out $150,000 of pre-tax profit, that IRR, if they died at 85, so if they started collecting CPP at 65 and they passed away at 85, that after-tax rate of return is about 3.68%.
Okay.
If they die at 95, because now they're collecting for a lot
Yep.
longer,
Yep.
and as we know, like average lifespans and mortalities are such that often when we're talking about financial planning, we're projecting all the way out to 90 or 95. If they die at 95, it's 4.3%. Now that's at 150K. I know many physicians are probably pulling out a bit more, and so I mapped out 300K. And at 300K, that rate of return, that hurdle that you should be looking at is 4.5% if you're dying at 85 and 5.08% if you're dying at 95. And that is a guaranteed after-tax
After tax.
rate of return.
I think that's the key there, Arvind, because so many times when I hear about projected returns or IRRs, I rarely ever hear about a discussion around after tax returns. Like, what are you actually going to keep? And so I think that's an overlooked point, and I'm really glad you're bringing that up.
Yeah.
Yeah.
So I will say the assumption, just so anyone is curious, is I said we're going to do 150 and 300K of gross
Yeah.
profit
Yeah.
to get one full year of CPP contributions. So they still have the ability to pay and get that entitlement. And
Yeah.
then they're going to start collecting at 65. And I tax this hypothetical case study at 43.41%. Because ideally, if you're deferring money, you're trying to defer to get from 53 down to at least at a base minimum 43%. So those were the assumptions I used. Now, what's really interesting is that's age 26. But what actually happens is if you are contributing, and each year is different, right? Because each year
Yeah.
we can choose to pay ourselves as a salary or we can choose to pay ourselves as a dividend. The later you are in life and you're making those contributions, the better that rate of return is going to look because you don't have as long a time period before you actually get another, you get your CPP, you get that entitlement. And so for someone at age 64 who makes 1 year of contributions, if they're eligible, and not everyone will be, but again, this is where doing the deep dive, figuring out your eligibility is important. At age 64, if they contribute for 1 year and then they start collecting in the following year, if they die at 85, that 150K individual, that IRR after tax is 6.94%. And at 300K, dying at 85, that IRR is 11.67%. So now we're hitting double digits of after tax. And then at 95, it's 8.64 and 12.76. But what the trend shows, if you kind of look at each year progressively, is the implication of CPP is that the hurdle rate of return becomes a lot higher as you get closer to collection date, if you will.
Okay, so big picture, what I'm getting here is that for somebody to beat the CPP investing on their own, you would have to have basically an after-tax rate of return of at least 5%, just to be on the safe side, which is probably not easy to do.
No. And, guarantee versus risk and all of those
Yeah.
pieces, right?
Okay, a couple other quick scenarios, and I think you have written on this before, but I wanted to pick your brain anyways. A common approach that people will use who are incorporated is that they will pay themselves salary. Salary allows them to contribute to, well, CPP and also the RSP. But then anything beyond that, they will start to just pull dividends for a bit of flexibility. I don't think that this approach is wrong. I've done it as well. But I wanted to get your take on that versus like strictly sticking with salary. And then this kind of is a preamble to my next question, where I also wanted to get your take on the IPP. But let's answer this one first.
Yeah.
Um, and I want to get your take.
I think first and foremost, it is important, and I think we'll talk about it in a sec, is there are some reasons to pay dividends. Like there are some nuances around RDTOH and
Yes.
CEA.
Yep.
If you are, as an example, like maybe you're staff at a hospital where you're like employed by the hospital, or you're at a teaching institution or something like that, where you have personal income that already helps fill up the CPP buckets, those are all reasons to maybe consider dividends from the corporation. But in absence of that, in absence of a defined reason to pay dividends, if we go back and we look at the logic, well, salary is more tax efficient. And so if we paid enough salary to already pay out our CPP, well, after that, there is no extra cost. Now we're just purely looking at it from a tax versus tax play. And so in that scenario, you're choosing to flip over to dividends to pay more tax for no defined reason. And so I would say if you are already in camp salary, then you should just continue with salary all the way through, especially because it creates, some benefits for other things like stated income for IPP and whatnot. But I would say, in absence of an actual reason to pay dividends,
Okay.
if you're flipping to dividends after you've already covered CPP, you're actually choosing to go from a more tax efficient strategy to a less tax efficient strategy.
Okay, and that's because of the small hiccups in tax preparation as we discussed. But and also I do want to mention to people, a lot of people already know about the loony doctor Mark South, but when I've gone through his blog, he's done some amazing work on RDTOH and the capital dividend account. So reasons to maybe adopt a dividend approach, and he's done great work on that. So people want to check out the loonydoctor.ca. It's a great resource. I think, Arvind, you are a good person to ask what your take is on the IPP, because often I'll hear the individual pension plan, the IPP discussed within our community, but I like to pose the question to people who do think about this on a day-to-day basis. You think about planning, you think about all these strategies. I'd love your take on the utility, big picture of an IPP for an incorporated small business owner.
Yeah, I think the IPP is great. I think philosophically, if we're talking about sort of your listeners, physicians, if you
Mhm.
will, I look at IPPs philosophically, right? You won't find this in sort of the legal explanation of what an IPP is or most of the
Mhm.
descriptions around it. For anyone who's heard of an IPP, it's basically like a personal defined benefit pension plan. The employer is always the sort of the backstop or the guarantee of this pension plan. And so philosophically, for your incorporated physician owners who are their own backstop, I look at it as like a supersized RSP because you get to put more money into the IPP. All of the, investment growth is truly tax deferred. And then some of the fees that are associated with it are now also a deduction to the corporation. And so in that context, there's been tons of research already. Looney Doctor, Jamie Golenbeck from one of the banks. I cannot remember which bank he's
Yeah,
at.
CIBC, yeah. Yeah.
They've all sort of discussed how RSPs in general, when you're thinking about diversified portfolios, are more tax efficient than a
Mhm.
corporation.
Mhm.
And so probably even more so now with capital gains tax. So if you liked an RSP as a physician, then in my mind, you should love the IPP because philosophically it's like an RSP with slightly better deduction capabilities and more room. And then, all of the other components with like the IPP being able to pay out yourself and qualify for pension credit and things like that.
Yeah, okay. Your perspective is very useful there. Thanks, Arvind. Now, I want to wrap it up with just discussing. I talked to Jason Yee about some scenarios about what the CPP payout would look like later in life, accounting for the basic CPP and then the enhancements. I just want to talk to you about some of the other benefits that can come with CPP. These are things I didn't really know about until I started following your work and reading more about it. So, three that come to mind are the disability benefit, the children's benefit, and then the survivor's benefit. Can you like quickly just touch base on what these are?
Yeah, so the disability benefit, if you end up with a severe enough disability, and it is different, so many of your physicians are probably, they've either probably been, you know, educated on or they have purchased for themselves a specific disability insurance policy with a lot more favorable terms around their job. CPP disability is, much more strict in its definition of when you might qualify
Hmm.
for it. But again, for many business owners who don't have other sources or abilities to purchase a disability policy, a total disability or something that maybe impacts your chances of having gainful employment later on is pretty severe. And so CPP disability will pay out sort of a fixed portion plus a percentage based on your income earnings up to that CPP amount until 65. So if you end up in a situation where, God forbid, you're paralyzed or you truly can't work anymore, CPP has a disability portion that kicks in. And so in all of the numbers we modeled, we didn't talk about that as like a cost of insurance, if you will. So that's like a bonus on top of these numbers
Okay.
that we spoke about.
Okay. And then can we talk about the children's benefit and then the survivor's benefit, just so people understand what these entities are?
Totally. So if you pass away as a person who's been contributing to
Yep.
CPP and you have children, minors, what actually happens is there is a calculation and they will receive a fixed monthly amount as a sort of children's benefit, if you will. So if I pass away, I've got kids, they will receive a fixed monthly amount for the time that they're minors up until 18. And actually, if they continue into post secondary, those payments will continue for a period of time as well. So in
Okay.
a way, it functions a little bit like an extra life insurance policy, in that while I have kids, there
Hmm.
is this extra coverage, God forbid. And same thing, we didn't
Okay.
factor the cost of that in as well. And
Okay.
then survivors pension,
Yeah.
I think was the last one, unless you had any
Mhm.
questions about the children's
No, no,
benefits.
no. That all makes sense to me.
Survivor's pension is similar but different. If you have a spouse or common law partner,
Hmm.
right, something that's been disclosed and properly documented, then what happens is same thing. That partner will receive a chunk of money monthly, and that chunk of money actually continues into retirement and will top up to a certain again maximum their CPP. So if you are in a situation where, and many business owners are, and many physicians are, maybe there's a higher income individual and a lower income individual, or someone who's maybe staying at home or working a little bit less to support the family. In all of those cases, they're probably not going to qualify for full CPP at retirement. And so in this case, that also functions as a bit of a, if you passed away, God forbid, that actually functions as a top up. And so that survivor's pension is, I believe, 60% of your amount that then gets added to theirs, subject to certain limitations. But again, it functions as a bit of another insurance policy that kicks in. And then there's one more that we didn't
Okay.
touch upon, very small, very minor, but there is that flat death benefit of $2,500 that gets paid out when you pass away, and it's meant to help cover final expenses and whatnot. So CPP does pay out a very very small nominal sum at that time that you pass away.
Is that just like a one-time sum?
Yeah, it's just a one time
Oh, okay. Okay.
500. So it many people I think have a bit of a grievance against it because what is 2,500, like when you think about the cost of funerals, when you
Yeah.
think about things,
Yeah.
does it really help? But at the end of the day, when we're talking about, like, we're fighting over an $8,800 contribution every year, I think it is kind of important that we at least note
Mhm.
all of those implications, all of those factors that come into play.
Arvind, I just want to say thanks for making the time to come on. I think this has been a really great overview on the relevance of CPP for, especially for small business owners, if they want to think about it at a different level and understand the true cost. I think you've done. I have to tip my hat to you, Arvind. You do explain things in a very easy to understand way, very digestible, and
Thank you.
I think that that shows your understanding of the material. That's how I always interpret it. But I think you're doing a great job.
Thank you. I really appreciate that. And I do want to say this podcast probably is going to come out and sound like very, very pro salary, and I am very, very pro salary in a lot of cases. But I think it is also important to note that everybody's situation is a little different. And so, you've already cited some of the other people who've done the heavy lifting on the research around this, but there are reasons to pay dividends. I think it just further, goes to show the value of, either doing the homework, like actually, getting under the hood and looking at these details yourself, or finding the right professional team that is willing to go that extra layer, because some of these nuances, I mean, we're talking about thousands of dollars, arguably tens, or in
Yeah.
certain cases, even
Yeah.
hundreds of thousands of dollars. And so it's important to really understand all of these fractional little bits. And one that was brought up to me recently that I didn't even think about yet, and for our this podcast,
Yeah.
was shred credits. Because I know that
Oh, yeah.
um, in a lot of research
Yeah.
institutions, that's an impact. You can
So
only get
that
that.
that's actually that's been a proposed podcast topic for me. A few people have reached out about that. So
Okay.
I can tell you I've been getting emails about this and I have just had my head in the sand. But I
Yeah,
think it's
yeah,
time to really dig my head, pull my head away and actually dig into this and understand it. So Arvind, I'm glad you mentioned that. I know we maybe did sound pro salary in this one. Maybe I could have challenged you in a few different ways, but I do want to point people to those other resources. So I mentioned Mark Soth, the Looney Doctor, but he and Ben Felix have done great work on variable compensation. So I think that's mandatory material for everybody. Highly recommend you go check that out to complement some of this information. But Arvind, let's wrap it up. Great job today. Pleasure connecting with you, and I look forward to following your work. Good job.
Thank you. Thank you very much. It was a pleasure.